you've got interest, you get that 1098E form from your student loan provider, you can still subtract that as an adjustment. You still take that.
So mortgage interest, no.
That's not an adjustment. That's itemized deduction.
Oh, I see.
And I'll get to that in a minute. Adjustments are things like student loan interest, moving expenses, alimony, self-employment, half of your self-employment tax, things like that. Self-employed health insurance, all of those are adjustments. And then this just outlines what I just said about credits subtracted from calculated tax. Here's another term that's useful to know about. A refundable tax credit is something that can actually result in a refund. Let's say, let me split this up between non-refundable and refundable. A refundable credit will lower your tax liability maybe all the way down to zero, but no more than that. So let's say that you're entitled to a non-refundable credit of $2,000, but your liability is only $1,000. Well, you're only going to get it lowered to zero, and you lose the rest of the credit. Okay? A refundable credit says you get that money no matter what. So if your liability goes to zero and you still have some credit left, it comes back to you as a credit, as a refund. And where you see this, there's two. There's one that you may be interested in. Let's say you have a child that's in college, and they're getting an education tax credit. Well, part of that tax credit might be non-refundable, and the other part is refundable. Also, on the new child tax credit that I'm going to explain in just a minute, part of that is refundable. So you get that no matter what, which is kind of nice. Didn't used to be that way. So, or you used to have to qualify with lower income in order to get it. Okay. So types of income, earned income, I think I've already talked about this. If you're on Social Security, there's a misconception out there that Social Security income is not taxed. I hate to break it to you, but up to 85% of it could be taxed so far. And if certain politicians get their way, it'll all get taxed. So if you're low income and all the income you're getting is Social Security income, it probably won't be taxed. But if you've planned well and you've got some taxable pensions coming in and that kind of thing, your Social Security will end up getting taxed. Portfolio income, I've already talked about this. Dividends, interest, royalties, capital gains, and passive income, limited partnership, rents, and capital gains on passive activities.
These incomes have different rates or are they the same rates?
Earned income gets hit with everything. Gets hit with income tax, Social Security tax, Medicare tax, everything. Portfolio income might be regular tax, or what they call ordinary tax, or it might be subject to capital gains tax, which is much more favorable. And I'll show you those rates in just a couple minutes. Passive income, and also portfolio and passive income, neither one of those gets hit with Social Security or Medicare tax. So neither one of those get Social Security or Medicare tax.
Passive income also on a lower rate?
On a lower rate? No.
So portfolio income is the one at the lowest rate.
Right. Right. So passive income, let's say on your rents, let's say you have a rental house, and after you subtract all of your expenses, you have a profit. Well, that profit is passive income, but it gets added into your total gross income, and the tax that you pay is ordinary tax rates. Yeah. Now, if you sell the property, and the property, you have a gain on the property, then that gain is taxed at, well, some of it could be taxed at capital gains rate.
But that becomes a portfolio income.
I guess it could be considered portfolio income. Yeah. Anytime that you're talking about capital assets, which would be stock ownership, plant and machinery, rental property, real estate property. Those are physical assets. And when you sell those, you sell them for more than you paid for them, that's a capital gain. Does that make sense? This is the tax brackets for 2018, the current tax brackets. One thing you'll notice, and I didn't put up the 2017 for comparison, but you'll see the top marginal rate is now 37. It was 39.6. There's a 12% rate in here. It used to be 15. There was a 25 in here. You know, these got adjusted a little bit. There's the same number of brackets. There's 7 brackets, but they've just been readjusted a little bit. And let me just say this about the Tax Cuts and Jobs Act, which I gave you the summary. The purpose of that act, there was actually 2 purposes. The main purpose was to grow the economy. And I think it's done, we already know that that's been pretty successful. The second was to give some tax relief to middle income. Now, if you're in the high income brackets, if you're in this region here, even though the top marginal rate has been lowered, once you do your taxes, you're going to find out that you're really not saving anything at all. In fact, you may actually be paying more. If you're in the middle rates, you're probably saving a little bit. If you're in the lower rates, you're saving considerably.
Compared to last year.
Compared to last year. Yes.
And this is taxable income, right?
This is taxable income, not gross. Yeah, this is right. After all the deductions have been taken, and now you're calculating your tax liability. That's what these numbers are. Okay. So you can see that, you know, until you you know, you're from 0 to $19,050, you're only getting charged 10%. So that's pretty good. Let me see. This is the capital gains rates. Now, what's changed from 2017? There's still the same brackets, the same percentages, 0, 15, and 20. It's the same. But the span of the brackets has changed. It used to be linked to one of these tax brackets. It used to be linked to one of these. So if you were in the, you know, the 25% bracket last year, then your capital gains tax rate would be 20%. If you were in 25 or more. If it was below that, you were in the 15. Well, now it's no longer linked to the tax table. Now it's got this different spread. Why they did that, I don't know, but they did. So it probably had to do with some kind of congressional requirement on budgetary matters, I think, but could be wrong. So I wanted to tell you about the standard deduction. We were talking about that change. We're no longer getting the personal exemption. It was eliminated. In 2017, it was $4,050 per person. That's gone. But look at this. Single person before had a $12,000 standard deduction. I'm sorry, $6,350 standard deduction. Now it's $12,000. Married filing jointly used to be $12,700. Now it's $24,000. So that's
like 30 person.
So the family is a big family.
not yet. Wait until you see the child tax credit.
Oh, I see.
Yeah.
Oh, okay.
Can you please go back to that portfolio income, capital gains?
Oh, the capital gain, this one here?
Yeah. Okay, so what he's saying is that if you sell stock and you make profit less than 77,000, you paid nothing? Yep.
No. If your taxable income is in that range, that's the tax rate on your capital gain income.
Yeah, don't worry, they're not that crazy.
Yeah.
No, I was mistaken then. I thought it was like, your no, okay.
So
But
your
that's a good-
taxable income have to be less than 77.
Not your, actually your income from passive.
Right,
I should let my son make the capital gain.
yeah, that's right.
James, since Bunana sees you with the like MFG, MFN, single and
Oh.
HH, would you please explain?
I'm sorry, yes, of course. Okay, these are abbreviations in the tax code. When you fill out your taxes, you'll see these abbreviations. MFJ stands for married filing jointly. MFS is married filing separately.
That means jointly meaning in a single return you put yourself and your spouse.
Yes, fine.
Right.
Yeah, together in a single return.
In a single return,
Which is the best.
which is the most favorable. Yeah, and let's go back to the tax table and illustrate that. You'll see here. Here's married filing joint, married filing separate. Look at this. When you get to the 24% bracket, 165 to 315 for married filing joint, married filing separate, 82.5.
But that's separately though, right?
Yes.
So then it's actually okay, the same.
Not the same.
Not
No,
necessarily.
Yeah.
I know, but this is separate, means the spouse will get that and I get that.
Yeah, yeah.
So then if you combine, no?
See, typically, well then, you would be right if
Oh,
you
okay,
and
I
your
see what
spouse
you mean.
earn the same amount of money.
oh yeah, exactly. Okay.
Also, remember before when I was talking about non-resident tax filings? Non-resident, if you're married, you don't have a choice. You don't have this. You're taxed this way. So let's say you're here on a foreign assignment and you make $100,000, well, you're in the 24% bracket. If you're a resident and you make $100,000, married filing jointly, you'd be in the 22% bracket. You see how that works? Yeah. And let me tell you something else about married filing jointly and married filing separately. If any of you have lived in another state other than this wonderful state of Texas, married filing separately might be a good option. Might be. Living here, it's almost never a good option. Why? Because Texas is what's called a community property state. So your property and your wife's property are your property together. That includes your income. If you make $200,000 a year, your spouse makes $50,000 a year, together you make $250,000. So if you choose in Texas to file separately, you take that $250 and cut it in half.
Oh,
Husband files $125, wife files $120.
really?
Really?
Oh my God.
And if you're filing separately, you're not entitled to certain credits. So, like I say, it's almost never a good idea if you live in Texas to do that. If you live in Illinois, maybe it would be good. If you live in New York, maybe it would be good. If you live in that god-awful state, California, that I came from, they're just like Texas. It's a community property state. So not only do you get screwed this way, but you also get screwed with high taxes. Don't go to California. Anyway. So, well, congratulations and we welcome you here.
So that is, what about if suppose like the wife housewife?
Say that again?
What about like wife, no job?
No
housewife?
income.
Oh, no income? Well, then that's good. Then you still file jointly, so you take advantage of the most favorable rates. So if the spouse does not work, you just have one income, then that one income is, you calculate all your deductions, you come up with taxable income, and then you look in here and you see what tax bracket you're in. Okay?
So is this bracket same last year? I don't know the date.
No, they changed it. Yeah, the number of brackets is the same.
The number of brackets.
There's still, and the top one is still the same, 10%. But some of these, and there was a 35 before, but these in the middle have changed. Like we didn't have a 12 before, I don't think.
And the dollar move a bit higher.
And the dollars have moved, yeah.
Question?
Yes,
We just earlier discussed about the California and Texas. So what is the difference with about the income tax in California and Texas? We would not like also to.
okay, well, California has an income tax for the state. So, as if you're not paying enough to the US government, they want you to pay to the state government there. Texas, being the wonderful place it is, we don't charge a state income tax.
We don't charge, Texas doesn't charge for the state
No state income.
income, but we still pay for the federal.
Yes,
Okay.
So in California, double, right?
yeah.
Federal.
And most states, I think there's only 7 states that don't have income tax.
Do they pay sales tax as well?
Yes.
Yeah.
But they don't pay property tax.
They pay,
Oh, they pay
property
property
tax is
tax.
lower,
Lower.
like 1 or 2%.
Yeah.
Ah, okay.
Yeah, we get nailed on property tax.
Yeah, but then your property price is
But in Texas,
4
you
times
pay-
more expensive,
You
so
pay twice as much property tax, maybe 3 times.
if your house is the same price
Yeah,
though.
you're right. Yeah, property tax here is terrible.
Like Silicon Valley.
Yeah.
Yeah.
Okay, and the other bracket that we talk about, single and head of household. Single means not married, no kids. Head of household means you're not married, but you have a dependent living with you. Like a child, it could be your elderly parent. So someday my kids, when they take care of me, they can claim me as a dependent. That could be head of
So
household.
single parents also have a household.
Single parent is also head of household.
Tax rate 0.
And head of household has a more favorable status than single. So you take a look here at the brackets. You see here, single at 12%, beginning at 9,526. Head of household is at 13,600. Okay, so now we go to this next slide. This just kind of illustrates a comparison between 2017 and 2018. Let's say you're single, 2017. This is your exemption. This is your standard deduction. So you don't start paying taxes until your taxable income is above this amount, which was just over 10,000. For 2018, there's no exemption, but there's a $12,000 standard deduction. So you don't start paying tax until after you've made 12,000. For married people, let's say with 2 dependents. So this is where you were talking about large family. It does look like you were better off in 2017 because here's your exemptions for you and your spouse. Here's your standard deduction, and this is the exemption for the 2 dependents. But this is just the standard deduction. Now I'm going to show you. Now this is coming out at 24,000 versus I think it's about 28 something, 28.9 something.
Yeah.
So here, when we look at your child tax credit, is now $2,000 per child. So that's, you have 2 children, that's 4,000. So you'd have 4,000 on top of that, so it'll bring you up to 28. So it's almost the same.
But you
But
say
you also have
But
child tax credit.
the child tax credit also has a cap on the income, right?
Right. It's been indexed differently. And so let's say, for example, if you were in a household where, let's just say, both husband and wife are engineers, making an engineer's salary, you're phased out of the child tax credit. You're not getting that anymore.
that's 2017. But
Yeah.
now you can.
In 2017.
What about 18?
2018 has been raised. So I'll show you.
Oh.
Yeah, that's been raised. First, before I do that, before I show you that, I want to show you a little difference between effective tax rate and marginal rate. Now, when I was showing you that table before, let me just go back real quick on that tax rate table. If you find yourself in the 24% bracket, that doesn't mean you pay 24% on your whole income. That's just on that portion, in that range. And then you pay 22% in this range, and 12% in that range, and 10% in that range. So it's progressive.
I see.
Okay, so in order to calculate your marginal rate, Here's an example. Let's say it's a single taxpayer, W-2 income 60,000, they have student loan interest of $2,500, standard deduction is 12,000. In 2017, it was 6350. Okay. So these are the lines in Form 1040 that you would put these numbers. So when you go through the calculation, he's in the 22% marginal bracket in 2018. He would have been in the 25% marginal in 2017. Here's the tax calculation. So you see I'm taking it 22% in that range, 12% there, 10% there. So the total is 59.29. It would have been 75.13 in 2017. So the effective tax rate would be the tax divided by total income. So his marginal rate is 22%, but his effective rate is 9.88. In 2017, the marginal was 25. The effective was 12.52.
What is the effective tax rate used for?
It's only talking points. It's really meaningless. For me, it's useful because I get a lot of people coming in, like, for example, a very common misconception is somebody will say, oh my God, my wife's small salary at Walmart pushes me into a higher tax bracket, I'm going to tell her to quit. And no, don't tell her to quit, because now you're going to have less money in your pocket. Because, yeah, you're in a higher tax bracket, but your effective tax rate is this.
But that's only after 2017, is that right? Before that? Is that because of the
Oh no, the new law has lowered it. So I'm just showing a comparison here between 2017 and 2018.
I see.
The calculation is the same.
I see.
So meaning in 2018, the income tax is lower compared in 2017.
Correct.
Around 3%.
Yeah. So let's say this person, earning 60,000 a year, that might be somebody like a police officer, makes about, a young police officer makes about that much money. So in 2017, you would have to pay $7,500 in tax. Well, if his salary didn't go up and everything stays the same, this year, he's paying $1,600 less. So when certain politicians say that the tax cut didn't do anything, BS. Now the one thing I caution you on is, and I caution everybody when they're making political judgments on the new tax law, is this: don't judge everything on your refund. Judge it on the calculated tax, because there's something when your employer withholds money, the withholding tax. That's based on a formula that you gave him authorization to withhold. If you didn't change your W-4, chances are he's withholding less money than he should. And so chances are you're not going to get as big a refund, or chances are you might actually have to pay a little bit this year, even though your tax liability will be less. And so you'll be grumbling, saying, oh, damn Republicans, oh, that damn Trump. But in reality, you're better off. You see what I'm saying? So we've got to think a little bit. I know in this group we don't have people like that, because we're all engineers. And engineers think mathematically. We don't think, in terms of emotion, like the general public does. So, anyway.
Because the bigger your refund means you're actually paying too much on your monthly paycheck.
Exactly. And when I was young, when I was first getting out of college, I got out of college in the mid-'70s when inflation was absolutely insane. And back then, if you're letting the government keep this money tax-free, I could have been making, believe it or not, I could have been making 10% in a passbook savings account back then. So it's crazy to let the government keep money back then. Today, who cares? But back then, it made it was crazy to do it. Right? The first condo I bought in Long Beach, California, my mortgage interest was 15.5%.
Wow.
And I thought I was getting a great deal.
Oh, wow.
Yeah. That was in 1980,
And that's for 30 years?
huh?
That was for 30 years?
That was a balloon, that was 5 years.
Okay.
And then I had to, but fortunately, Indonesia wanted me to move there, so.
Okay.
So I sold that property and got out of it.
So, then you mentioned that W4 has to be adjusted from last year to, how do we know that and how do we estimate that it's going to?
Well, you should have received an email or a notice from your employer
But then how do we
last
know
year.
that I need to either add more or take it? No?
The new W-4s have a more complicated but more accurate calculation. So where it used to get people in trouble would be if husband and wife both had income, because the husband's employer doesn't know anything about the wife, the wife's employer doesn't know anything about the husband, right? So they end up withholding as if it was a single, one income. So then when you combine the two at tax time, they end up in a higher bracket, and they end up having to pay money. So, but now they have adjusted. So if you log on to irs.gov, get the new W-4 form with instructions, it will give you a more complicated, you guys can handle it, a more complicated calculation that takes into account your spouse's income. And so then your withholding will be more accurate.
Oh, but that's good for next year though, for the one that already passed, if W4 is.
Yeah, well, yeah, exactly. It's kind of like a moving target. So you can adjust your W-4 right now for the income that you're earning in 2019. Yeah, but for 2018, that's, that ship has sailed.
Just later in the slide, we have an examples where someone actually pays more taxes because of the new law.
I don't have an example like
So
that.
this is the only example you have.
Yeah, that's the only example I had.
Maybe for the
How
one
much
who
you
makes
got?
600,000.
600,000, yeah. I should put a big one in there. I've got one client that is in that category, and he's actually having to pay a little more money. It's not a lot more, but it is more. So, tax, it's called the Tax Cuts and Jobs Act. Well, his tax didn't get cut, and he already had a job, so didn't do him any good.
Does the tax regulation change every year or
Yes.
every year? it
Yeah,
change?
well, generally, yes. And this is the first big change since 1986. Since 1986, we've had little bitty changes going along the way. Yeah. And there have been a lot of common sense changes too. And I'll get to those. I'll point those out in just a minute. Here's one of them that you may not like if you're planning to get divorced. The way it's always been is if you were divorced, if you got divorced, and if you're the one paying alimony to the other spouse, to your divorced spouse, the money you pay can be taken off as an adjustment to income. So, remember the adjustments come before adjusted gross income. So you get to subtract that from gross to get adjusted gross income. And then the spouse that you're giving the money to has to declare it as income. Now, no more adjustments. The spouse getting the money is getting it tax-free. And you're shelling it out and paying taxes on it. So, if you're planning to get a divorce, you might want to wait until, I think this law expires in 2016, so.
Unless you get divorced in Texas, right?
Well, yeah. And in Texas, there's generally not alimony per se. And alimony is not child support, so that doesn't count.
Just you wait until you die.
Yeah. So, yeah. So moving expenses, I said before now, moving expenses used to be a big deal, especially for engineers who move a lot. If you're moved for the sake of your business, you could take that as an adjustment to income. Yeah. Rick?
Question. What is alimony?
Oh, alimony is it's like
Like child support, right?
it's not child support. It's basically spousal support. So let's say back in the old days when the husband was the breadwinner and the wife stayed at home and took care of the kids. Okay, and then if they got a divorce, the husband would have to pay the wife a certain amount of money, because her job previously was taking care of the house and kids. And now since they're divorced, she no longer has a job, so she has to pay her, he has to pay her.
Oh, cool.
So,
Every
yeah,
month.
that's what alimony is. And it's kind of, a lot of people think it's an outdated concept. Maybe it is, maybe it's not, I don't wanna make a judgment on that. But yeah, you don't see it too much anymore. Yeah.
You have to pay it for like the rest of your.
It's based on the court order. So the court, you know, especially if it's a young married couple that gets a divorce, the court order might be for 2 years, 5 years, 10 years. Generally with young women who would get divorced, I'm talking about in California, the court would almost never award anything more than 5 years. Because the judgment is that she's young enough, she can get her butt out and get a job, right?
Usually that's as long as the marriage is in it. Like if it's only a 2-year marriage, then you only get 2 years.
It depends on the judgment, not on the length.
Excuse me?
And every state's different, so it might be that way in some states.
I think until the ex-wife or can settle or remarried again.
Generally, alimony terminates with remarriage. But it also terminates by the court date. So the court could say you get it until 5 years. That's what I've seen in California. In Texas, I never